Okay, let's get started. Let's start off with any questions that you all might have. Gonna put the exam, again, when they're pretty close, everybody's taking it by now. I looked last week in Swordsburg, pretty close to what I was expected, so. Exam, homework, research project, I'll go, okay. We'll be able to look at our exam regularly for the long. Yeah, we can't look at it until the window closes. But as soon as the window closes, people go out there, look carefully, hang out, and if you missed anything, there's an explanation about why you missed it. So that still leaves a question of, but that. Well, if you think of something else, interrupt me. I was up today watching the Chiefs game last night, and I had to get up early, so I'm struggling. But tonight we have what should be, we'll get out of here a little bit early tonight. We're talking about bond pricing. So for the last few weeks, we've been working our way through the income statement, and then we shift to the balance sheet. We talked about asset recognition last week, and now we're moving into the liabilities and owners section, and now we're talking about liabilities. So for corporate America, when you look at the liability section, you have short-term and long-term debt. Within the long-term debt category, most of that debt is typically bond issuance. And there's this will be a review for everybody in the room. You've had this in your finance one-on-one class. I don't know how long it's been. But if you can recall the fundamental relationship between bond pricing and interest rates, that's this whole thing. We're going to talk about the accounting for that, how to book premium, how to book a discount. We're going to go over some terminology, and then our authors leave us with the last learning objective in module 7 is just the time value one. And I'm not going to cover time value. If you need a refresher, it's out there. There's also support videos on my business course. Going to give you some instructions and tutorials on how to use the calculator, how to use Excel. Just know how to use Excel, and you'll be fine. So let's talk a little bit about liabilities, and then we'll dwell on bonds a little bit tonight. You know, surprisingly enough, I say, as long as you understand that basic relationship that when interest rates go up, bond prices go down, and vice versa, that's the core of this whole module. I've been working with investors for the better part of 30 years now, and the typical investor just does not grasp. They do not grasp. When interest rates go up, I get calls from clients, prospects, early investors with basic questions about, well, isn't it time to buy bonds? Interest rates just went up. Well, maybe, but they don't recognize that means that any bonds they have in their portfolio just declined in price. And that's the disconnect right there, because I was thinking about that on the way in. You know, why is that so hard for so many people to grasp that when interest rates go up, bond prices go down? And I thought, well, it's not a one-for-one mechanism. Like when interest rates go up, it's not, what is the price of the bond? But the price of the bond is just what any single investor is willing to pay for it. So I'm an investor. If interest rates go up, why am I now less willing to pay the same price for a bond? And what is it about when interest rates go up? Why am I less willing to pay the same price for a bond? Well, we're going to walk through that tonight. That pricing mechanism is just the investor. That's just me recognizing that, well, interest rates just went from, interest rates just went from 5% to 6%. And I have this bond. Yesterday I was willing to pay $1,000 for it. But I look at it and I'm like, well, that bond only pays 5% interest. There's all these other bonds out here that pay 6%. I could buy them. So it's not so much that the price changes, although it does. It's really the opportunity cost that changes. When interest rates go up, it's the opportunity cost changes. Now investors have the choice of putting their money to work at 6% interest. So that opportunity cost requires all rational investors to say to themselves, I would never buy this 5% bond. Unless I can get it for cheaper. And then a discount is applied to that bond. And the equilibrium point brings the traded price of that bond down to the point where it's now competitive with all other bonds. And what's that competitive price point? Something that equals a 6%. So now, when interest rates go from 5 to 6%, the opportunity cost adjusts, and the price that pushes the price down, and it makes it competitive with other bonds. So we'll walk through that dynamic tonight. If you have a good handle on that, then you can give yourself the thumbs up for module 7.
So that's just like current bond, whatever, is like issued in the market that the deals are all price with them.
Current bonds already.
Your bonds, whatever, when your business feels higher, the bond, probably $1,000 or more.
Yeah, you got it. So the way the mechanics of the new issuance works, if one of the companies that you do research on this semester, if they want to borrow money, they go to a broker dealer like Goldman Sachs. And they talk to their counterpart at Goldman Sachs, and say, okay, we need $100 million. Goldman goes to all of their subsidiary banks, and they gather $100 million, and in exchange for that money, they issue $1,000 coupon pieces of paper. So these are bonds, typically they have $1,000 face value, and what accompanies that $1,000 face value is a coupon. So it's printed on the face of the bond, and it'll say from 5% or 6%. And then once that's issued, these pieces of paper, these bonds, they have a term associated with them. They'll be outstanding for 5 years or 10 years, maybe even 20 or 30 years. It's printed on the face of the bond. But until they come due, the holder of that bond will receive interest payments. And when if they ever want to sell that bond, they can sell it just like a stock. So if everybody in this room is B market, we can trade bonds back and forth amongst ourselves. And the price of those bonds will be determined on the interest rates of the day. So that's going to fluctuate, that's going to determine all of our opportunity costs. And you'll see the bond prices go up or down based on the prevailing rates of it. So whenever we have a bond that differs from the prevailing rate of interest, that pricing mechanism is going to be recorded on the balance sheet as the face value of the bond plus a premium or less a discount. So as that price fluctuates, you'll see that premium and discount get credited to the balance sheet. And then what makes this an advanced concept is that we, if we're all working for the same company, for Microsoft or for GM, as we see those premium and discounts fluctuate, we have the opportunity to buy back our own debt. So the company can buy it bonds just like the company can buy it stock. So if interest rates go way up and price of those bonds go way down, it may make sense for the company to buy back that debt at a lower price than it initially issued at that point. So when that happens, you're gonna see a gain or loss show up on the thing. So the hidden piece of value where you might just kind of begin to noodle on is this is not always disclosed, but you're gonna be tasked with finding several tables in the back of your 10-K filing that disclose all of the debt the company has outstanding. That's the face value of the debt. Okay, as a next step, I want you to find out where those bonds are trading today. Because you might not know if the company has the opportunity to buy back its bonds and book a gain unless you go out and you find the price of the debt. Now, once you know that, that's very valuable information because that could be a source of hidden value. You could execute that transaction today and book a gain if you wanted to, but that doesn't occur just everything when they're looking at the 10-K. That's one of the, that's one of the reasons why we have financial statement analysis. So let's walk through the balance sheet a little bit. We're looking at Verizon in module 7. So you can see the liability section of the balance sheet is usually broken out between liabilities that come due within 12 months. So you have debt maturing within 1 year, 9.9 billion. That's an important number because you're gonna need it for your liquidity analysis. So you have kind of two jobs, it's really the same job, but it's broken out in two different time periods. Within the next 12 months, Verizon needs to come up with $9.9 billion, and it's your job as the financial analyst to understand where that money's gonna come from. Now, if they have $9.9 billion in cash sitting on their balance sheet, then no problem, right? There's no big mystery about where they're gonna come up with $9.9 billion. If they don't have $9.9 billion in cash on their balance sheet, then you're gonna look to their statement of cash flows from last year, and you're gonna ask yourself, how much cash do they typically generate? And if Verizon typically generates 20 billion in cash, then paying that 9.9 billion is no problem. If they don't have the cash and they don't have the cash flows, and the cash flows aren't expected, you might have a problem. Well, where are they come up with 9.9 billion? Are they going to sell off some assets to generate that cash? Or, you see this quite a bit, and it's always little things like, reminds me of that old Warren Buffett quote that says, nothing else, it says, you only find, you don't know who's been swimming naked until the tide comes up. So strategy that we see a lot of companies employ is something that's called evergreen debt. So evergreen debt just means that a company like Verizon would plan on paying that 9.9 billion with another loan. So they're gonna pay off this loan, they're gonna pay off Goldman Sachs, and they're gonna borrow from Bank of America. That happens all the time, it's called evergreen debt. In a normal business environment works just fine. But in an environment like we had in 08-09, the great financial crisis, where we had legitimate liquidity concerns across the entire banking world, the ability to borrow 9.9 billion is not guaranteed. It might be typical, might be conventional, it might work 90% of the time, but there's gonna be that one market in a decade where that money's not there, and then you're in a world of hurt. Because now you can't repay your loan, you've likely triggered some covenants associated with that. And depending upon how the documents are worded, Verizon or Verizon's bank in this case could push them into liquidation or bankruptcy. Moving on down the balance sheet, we have debt occurring beyond 1 year. Well, these are all current liabilities. I take that back. Over here, we have liabilities. Nope, this whole slide is current liabilities. So accounts payable, all of the typical suspects there. And you'll notice that we have accrued liabilities in that section. So this is accrual accounting. We've talked about this several times this semester. Accrual accounting requires us to make certain adjustments to reflect monies that we will owe as a result of the business we've done during the period, but we're not paying those yet. So we're just putting on the balance sheet as future payments. And the best, probably easiest example of this are wages. We get to the end of an accounting period, maybe it's December 30th, end of the year. We're trying to wrap up our books, we're gonna close our books. And our employees have worked, maybe they get paid every 2 weeks. And they've worked the first week. So we owe them that money, but we're not gonna pay them for another week. It's a minor difference, small, probably not particularly significant, but we do have to report it. And this accrual accounting can become very significant. There are large liabilities that we will need to reflect on our balance sheet and accrue for. So we make those adjustments at the end of the year. Here's a couple more examples. Underneath routine contractual liabilities, I mentioned wages, unpaid interest is another good one. Interest accrues every day. So when we get to the end of the accounting period, if we haven't written a bank check, we need to accrue for unpaid interest, income taxes, other expenses. And then we have contingent liabilities, and our authors give us two examples here. litigation, which you rarely see. And the reason for that is, in order to book a contingent liability, it has to meet two criteria. It has to be probable and it has to be estimable, meaning you have some idea of what that liability genuinely might be. Well, for litigation, you never want to give an aggressive prosecuting attorney the opportunity to point to your accounting and say, somebody in your internal staff obviously thought it was probable that you were going to be liable in this lawsuit. Because it wouldn't be on your balance sheet unless it was probable as a rule of GAAP accounting. Okay. That's litigation. That's the reason why we typically never, very rarely see them. Warranty liabilities are very probable. If you're Harley Davidson, you know with near certainty that X% of every Harley that leaves the line is going to have some warranty. And you're obligated to make adjustments to that. And not only that, but it's estimable. Because you have 100 years worth of service, say, okay, well, we know with darn near certainty that 2.5 or 3% of every dollar we sell is gonna come back to us in the form of margin. So we just take sales last year times 3%, we go to warranties. Warranty expense would be the debit. Warranty payable would be the credit. Okay. Talked about this a few weeks ago. Our authors also used the example of unearned revenue. Yes, unearned revenue. And I mentioned that it took me forever to figure out that unearned revenue and deferred revenue were the same thing. So if I can save you the headache, just star that right now. Unearned revenue and deferred revenue is the same thing. It's listed under accrual accounting because when we are paid in advance, we can't book a revenue. We have to book a liability because that now encumbers us with the future responsibility to do something, to deliver the good or service. So in this instance, we don't pay off that liability with cash, like we would with most liabilities. Most liabilities sit on our balance sheet, so we're ready to pay it, and then we write a check and they go away. This is similar, only the liability sits on our balance sheet until we're ready to deliver on that service or deliver on that good, and once we've executed that and fulfilled our end of the contract, that liability is worth. Sometimes students get a little bit confused just about the naming conventions that an unearned revenue shows up as a liability. That can be counterintuitive, but it is in fact a liability. Okay, let's look at real quick at an example of warranty expense. Here, I think we're looking at Harley. Okay, sales during the period are 10,000. We're gonna assume that 2% of those sales are defective and repairs cost $5. So warranty expense equals $10,000 of sales times 2% times $5 equals $1,000 of warranty expense. So we're gonna book that as a warranty expense, would be our debit. Warranty payable would be our credit. That flows through to the balance sheet. And if you can grasp that slide there, you're probably good insofar as the homework and exam is concerned. But for your research project, you need to dig a little bit deeper and find this table in the back of your table. This table is going to show you warranty expense, warranty payables, how they trended over the last few years, what estimates your management teams have used, estimate the resident flag. Every week we talk about the subjectivity of this accounting, and if you wanted to manipulate it at all, where would you look? Well, warranty expense is one place you might go. If you wanted to drop earnings to the bottom line this quarter, what would you do? So if I go back
one slide. This is the transaction that we're working. Here's retained earnings. We have, well, we really only had two accounts. We had warranty payable and warranty expense, and they're the exact same number. So if you wanted to drop earnings to the bottom line, you want this warranty expense to be higher or lower? You want it to be lower. The lower that warranty expense is, the higher your earnings are gonna be in any period. So this slide showed, wait, no, I went too soon. The second line, warranty expense equals 10,000 times 2% times 5. Where does that 2% come from? It is it's a made up number. That's the answer. Where it's supposed to come from is careful analysis of warranty expense that we've experienced in the past. So we should have a good idea of what that is. But if you wanted to tinker with that number, if you wanted to say it's not gonna be 2% this quarter, it's gonna be 1.75, you spin a story. Well, we've been having trouble with our manufacturers coming out of China. The warranty expense the last few years has been a little bit higher than what we would have liked to it. So we're switching to a new manufacturer in Indonesia, and we expect the warranty expense to drop from 2% to 1.5. Just tell whatever story you want to tell. The point is that what goes along with that story is a lower warranty expense and a higher earnings. And this is the cynic coming out of me, but when you see incentives aligned with earnings, and then you see accounting change that's gonna make those incentives come due to the benefit of the management team, you hear a lot of good stories that come along. And they're not all shenanigans. Sometimes companies deliver. I just structure this class so that we can all be aware of what happens to those earnings and that bottom line.
There are anything like the utility company, like, they don't necessarily have a warranty, or they have an outage. It's like, not really like outside circumstances, like a company go after them when they're like down for a day, but
I'm sure. Yeah, I don't know what the utility company would call that liability on their balance sheet. That's one of the challenges to doing these research projects, is that when you get down into the accounting, there's no set naming conventions for some of these liabilities. Just kind of have to have the wherewithal to recognize as you're reading the 10-K file that, oh, okay, that's a contingent liability. That's happened in the past, probably gonna happen in the future. They may return. So sometimes when you fly out an airline, if you're delayed by more than 6 hours, you'll get an airline credit. That'd be similar type of contingent liability that you might see occur. Okay. This class always takes us in the same direction, which is, now that we understand the accounting and we understand the potential for the accounting to be manipulated, how would we adjust for that as analysts? Well, as analysts, we say, okay, warranty expense, that might be BS, we don't know, we're gonna throw it out. Management team told us that would be 2% of sales. We don't like that number. We think it should be 3% of sales because that's what it's been historically. Well, we just recast the financial statements. In this example, our authors are assuming that rather than the current estimate that management puts forth, we want to use the historical average. So we take warranty expense over the last 3 years, we divide it by revenues over the last 3 years, and we get a historical average of 0.9%. And then we can use 0.9% times sales in each particular year to get a new estimate of warranty expense. So we take the old warranty expense line item, we delete that, we put the new estimate of warranty expense in, and we let that cascade through the financials. So now we have an adjusted set of books. Now, if we're just looking at warranty expense, we can go from 2%, 1%, that's probably immaterial, not gonna make a big difference. But by the time we get to the end of the semester, all of these adjustments that we're making, the same plans, are gonna go into the Excel spreadsheet where you're building the value of these companies. You're gonna recast the financials from revenues all the way down to earnings. And you'll have a real picture of what you believe to be the truth is. The fundamental, underlying economic reality of that business. And it can build up and it can be meaningful. And you'll recall what we're trying to uncover is what I call a variant perception. So we want to identify those circumstances whereby the use of our financial analyst skill set, we now have a set of books that we believe to be more accurate. We now have a set of books that we believe to be a better representation of the true value of the company. And when the true value of the company that we estimate differs from the stock price, differs from the Wall Street consensus, we have a variant perception. It doesn't happen very often. But it's the only opportunity you're ever gonna have in the stock market to make any real money. If you go through all this work, value the company at $100 and its price is $100, well, that's an efficient market. There's no opportunity here. Now, that's not to get discouraged, because if you do this as a business, if you're a portfolio manager, that work never takes place. You just update it on a quarterly basis and wait. The biggest piece of value in being a portfolio manager is in patience. You just have the patience for the market to go through that next great financial crisis. You're gonna be buying stocks like right away.
I want to get rid of the quarterly reports, you think that will happen? Or-
Yeah, I saw that. I saw it. I don't know. I don't know the process for doing something like that. I don't know if the SEC can just do it by decree. It comes up with what I want, and I have power to fire and hire the governor of the SEC, so do this.
You think that?
I don't even know how I feel about it. Part of me wants to say that, well, 6 months is probably sufficient time to get the next best data point on just about any business. So I don't have a big problem with it. But
You think like you did very little kind of, let's say like within this AI level, what people say that we're in right now. You think I would worry investors in a lot more than 1 month, if they don't want to wait 6 months to get a report on, 200 price earnings, company, what's going to happen?
I could argue both sides of that. Part of me wants to say that the market is so smart that they can look to other data to gauge the success of AI. This is outdated now, but I remember years ago, when they first started with satellite imagery, that was of any quality at all. The hedge funds in New York figured out that they could front run Walmart's earnings in it by counting the cars in the Walmart parking lot. And it was just a simple correlation: more cars, higher earnings; less cars, lower earnings. And they had all of the data from the satellite industry well in advance of Walmart's earnings. So they just buy or sell the stock based on whether or not the earnings were likely to be higher or lower than what Wall Street thought. So I suspect that with AI can probably value itself in a more sophisticated way than satellite imagery could ever value Walmart. And you start to see now what hedge funds seek out is unique data sets. The data is becoming extremely valuable. And one of the unique data sets that we were being sold on a few years back was electricity usage out of China. So you can kind of front run production and manufacturing just by watching electricity usage. And I've heard that mentioned by other portfolio managers that I personally hold in high esteem as a better reflection of any of the data that China actually publishes, because when they publish a piece of data, it has to be approved by the CCP. But you can get data on electricity usage that's not official stat, it's just electricity usage, and I'm not sure where they're getting that, but I thought it was a pretty good argument. I'm like, okay, they're claiming this other data set can be manipulated, then why not look for one that can't, and they were claiming that this one couldn't. But now I would look for like, you know, data center construction, that type of thing. I read this week that second quarter GDP was, I think it was 1.6. But if you stripped out all of the construction going to data centers, it would have been 0.3. Right. Sure. The AI as a force inside of this economy is really the sole driving growth factor. And if you look at the capital budgets of the Magnificent Seven, they have forecasted $1 trillion worth of capital expenditures over the next 3 years. So that's this year, 2026 and 2027. Unbelievable. I don't know where it's gonna go, but it's fun to watch. Okay, let's move on to learning objective 2, analyze short-term debt. Okay, there's really only 2 slides for this learning objective, and I'll just hit on the second one here, which is what did I want to say? This is, never mind, this is just an amortization table, nothing tricky about it. Really needs no comment. Okay, long-term debt, let's talk about bonds. I want to make sure that we all have our terminology down, because the terminology can be, it's not tricky, you just need to know it so that you can have a real conversation. So look at the terms in blue, face amount, generally the entire face amount, that's principal of the bonds is repaid at maturity. So when I say face value of the bond, that's the principal value of the bond, and there's a difference, but they're interchangeable between the face value of the bond and the face value of the issuance. So the issuance is really the total amount of money that is borrowed. The bond is the increment of $1,000 piece of paper that it's chopped up into, so it can be initially distributed, sold, and subsequently traded amongst the general public. So the face amount of the issuance, call it 100 million. The face amount of the bond is $1,000. Interest payments are made in the interim. Interest payments are usually made semi-annually. And they're going to take the coupon rate of the interest. The coupon rate is printed on the face of the bond times $1,000, and that's going to be your interest payment. So this slide talks about the mechanics of the transaction. I mentioned that the broker dealer a company would use could be somebody like Goldman Sachs. So they're going to go to Goldman and they're going to say, we need to borrow 100 million, and Goldman's going to help them get all the money in exchange for all these individual bonds. So the underwriter is the company issuing the bonds. They sell to individuals, usually in $1,000 denominations. They receive a fee for underwriting the bonds, and then these bonds are investments for individual investments, investors, companies, retirement plans, insurance companies. They can trade in the secondary market. We talked about that. Bond prices are going to fluctuate. We talked about that. And coupon rate, I mentioned the coupon rate. That's printed on the face of the bond.
On that last slide, they did say that, even though the prices fluctuate, they're required to pay the face value of the purchase that is a person borrowed at maturity.
At maturity, yes. Yeah. Before maturity, it can trade at almost any price. At maturity, you get let's just call it $1,000, because they trade at $1,000 increments 99% of the time. At maturity, you get checked for $1,000. If you don't trade these bonds, like say I buy a bond and I hold it to maturity. I pay $1,000 for it today. I get a 5% interest payment semi-annually for 10 years. At maturity, I get my $1,000 back. And that's a very simple transaction.
You'll change with the price fluctuating there, and you get the same deal with it. The price is perfect. But if $5,000 bond goes out, it's reasonable. But
In the example I gave, if I buy it on today for $1,000, my yield is 5% times $1,000, so that's $50. Or $50. And I get a $50 check on my annual for payment,
doesn't matter what the price is.
no matter what the price is. Okay, now, we're gonna talk about something called effective rate. The effective rate, or the market rate, I wish we didn't have more than one term for the exact same definition, but we could do effective rate and market rate are the same thing. So if I buy a bond for $1,000 today, 5% coupon rate, and interest rates go to 10%. The price of my bond is gonna go way down. But in the example that I drew out there, I never sold it, I sold it. And then at the end of the maturity, I got $1,000 back. So do I care? Maybe not. Maybe I don't care. I would care if I wanted to sell it, if I needed to liquidate it, because I would take a big loss. Or if interest rates went down, I could sell it for a lot more than $1,000. But if I never sell, then that's a pretty simple transaction.
So when it's going on like for accounting statements, the company has to say what you bought, like what the debts were that day, or sell it, and they say like this will, that. For all the.
Yeah, so, we're gonna take a deeper dive into this question in module 10. Because companies have two categories of bonds on their balance. They have available for sale trading securities. And they will mark those to market. Meaning that if interest rates go up, the price of the bonds go down, they will change the value of those bonds, depending on the value, and then the measure of the law. There's another category of bonds called held to maturity. And when interest rates go up and down, a company keeps those held to maturity securities at face value. So that would be $1,000. I mentioned a few moments ago that if you wanted to kind of look through and try to find big value anywhere on the balance sheet, that's where you would look. So let's talk about this effective rate and how it results in premiums and discounts. Okay, let's start with a very simple example, just so that we're all using the same numbers here. Assume a company issues the following bond, we got a face amount of 10 million, 6% annual coupon rate, which is 3% semi-annually, matures in 10 years, i.e. 20 semi-annual periods. So we're using this is why the time value of money concepts are in the same chapter, same module as the bond pricing. Because we're using all our time value of money concepts to figure out what the bond is worth. So in this instance, we have the number of payments equals 10 years times 2, so 20 payments. The dollars per payment is 300,000, so 10 million times 3%. So here's our cash flows. We have 6 million in cash flows from the interest payment that we just calculated. And then at the end of the period, we have a $10 million face amount that's coming back to us at maturity. 6 million in interest payments, 10 million in maturity payments for 16 million in payments. Now, let's value that as of today. So that's this bottom section. If we're going to use the present value of an annuity factor, which really pretty present value of an annuity factor, you just use a spreadsheet, or you just use a financial calculator, but they continue to publish the tables in our books, so have some patience and we'll walk through this. So we have a $300,000 payment And the present value of annuity factor, in other words, what's the present value of a $300,000 annuity stream for a period of 20 years? Answer to that is $4.4 million. What's the present value of a $10 million payment 20 years from now? Discounted back at 3%, that's 5.5 million, or 10 million in face value. This is what we borrowed. This is exactly what you would expect. $10 million, that's what we borrowed. Obviously, it's worth $10 million today. The exercise just shows you how that's broken up. That's broken up between the interest and the principal paid back at the end of the term. Okay, now what happens if the interest is not 3%, but goes to 4%? So if instead investors demand a 4% semi-annual return for the 3% semi-annual coupon bond, everything changes. Now we have the same payment. We have the same $300,000 payment. That's semi-annually for the next 20 semi-annual period. But the present value of an annuity factor, that changes because now we're discounting those payments at 4%, not 3%. Same for the $10 million payment we'll get at the end of 10 years. When you discount those back at 4%, now that bond that was worth $10 million is only worth $8.6 million. So this is a good real life example. This is very plausible. Borrow 10 million a day. So 10-year, the 10-year treasuries is at about 4.3%. Maybe 2 years ago, it would have been at about 3%. So within 2 years' time, this is a very plausible example. A company that had issued at 3% experienced interest rates rise, and the value of that debt went from 10 million to 8.6. I don't remember if we're still dealing with Verizon here, but let's assume we are. So Verizon has a choice. They can just keep paying interest in accordance with the terms during their original issue, or they can go out into the market and borrow that back. Now, they'd have to come up with 8.6 million in cash, but if they had that on the balance sheet, they could buy it back. And in doing so, they would have relinquished the 10 million on their balance sheet. And that plug figure shows up as a gain, and it is a real gain. That'd be $1.3 million in gain just to buy that debt back. Okay, other way around, 2% interest rates decline, the value of the bonds go up. Because other investors, everybody else in this room, they say, hey, that bond over there has a 3% coupon. If I buy that bond, I'm getting semi-annual interest payments of $300,000. If I buy a bond that was issued today, I would get semi-annual interest payments of $200,000. So the investing community says, well, I like that a lot better. I'm willing to pay more for it. And you see that in the calculation here, the present value of the annuity stream is now worth $4.9 million. The present value of the principal payment is now worth $6.7 million for total issuance value of $11.6 million. Okay. We'll do a little star by exhibit 7.1 here. If you need to come back to it while you're taking the exam, it's an open book exam, so you might as well star the slides that are most useful to you. This is your little cheat sheet. If the coupon rate is greater than the market rate, then the bond sells at a premium. If the coupon rate equals the market rate, the bond sells at par. And if the coupon rate is less than the market rate, the bond sells at a discount.
Okay,
I need a bullet point above the first bullet point. I need for you all to recognize that it's very common for companies to issue bonds with a coupon rate that's different from the prevailing market rate. So the example we just looked at on the last slide, the prevailing market rate was 2%, and the coupon rate was 3%. That happens all the time. A company will issue, and sometimes it's just because it takes 5 or 6 months to go through the whole process. You gotta issue documents, you gotta file with SEC, you gotta hire a broker dealer, you gotta work with Saks. It can take months to do this. So you set the price of bond early on in the process, and by the time you actually get it to market, the interest rates have fluctuated. So that may require you to book on your balance sheet a premium or a discount from day one. Once that's been established, then, as our authors noted in the first bullet point, the effective cost of debt is used to determine interest expense. Every semi-annual period, we're gonna write a check for $300,000. That's part of the interest expense. If that bond was issued with a discount or a premium, the other part of interest expense is gonna be the amortization of that discount or premium. Every 6 months, we're gonna partly amortize that, and that number is going to be the second component of your interest expense. Which is why our authors note that the effective cost of debt is used to determine interest expense. Okay. This is a good example of the type of disclosure that you're likely to see. This is unique to the 1.2 billion euro issuance for notes due in 2030, and 1.2 billion euro issuance of more notes due in 2034. It's beyond the scope of this class that you would find the prospectus associated with those bonds, or they would call it a memoranda. But what you will find are tables in the back of your 10K, and I have an example for you here in a moment, that show you the issuances outstanding for a company like Verizon. That looks like this. So here you have Verizon. You have maturities ranging from less than 5 years all the way out to greater than 10. Each of those issuances have an interest rate associated with them. So you can see that the interest rates go from 0.75% on the low end, all the way up to, looks like 8.95% on the high end. And it's important to recognize here that every single one of those issuances is a different animal. We are not looking at apples to apples. Anytime that you're identifying bonds, and I think this is probably one of the reasons why bonds in general represent an outsized part of the market where we can really have an opportunity to create value. Anytime you're looking at a bond, you need to recognize that that's built on top of contract law. Every bond issuance is a contract between the issuer and the buyer of the bond, the broker dealer that set that up. And because of that, they can have terminology and contractual clauses that position that bond anywhere in that capital structure. There can be covenants associated with those bonds. There can be collateral associated with those bonds. There can be triggers that allow that bond to be a part of convertible issuances. There can be preferred treatment of those interest payments. Sometimes they can be cumulative, sometimes the company can maintain it right to buy those bonds back, sometimes they can't. All that legal terminology makes those bonds more attractive to an investor or less attractive to an investor. And on net, that attractiveness determines the interest rate. And then that interest rate, i.e. the face value, will relative to the market and to also determine the price. Which is why you see a company like Verizon have what looks like 12 different issuances, all at 12 different prices, and you don't really know what you're looking at until you pull up the memorandum and understand all the little pieces of terminology that I just went through, which is beyond the scope of this class, but I highly recommend it because we can find some great opportunities to put money to work. And because the bond market is so illiquid, especially for some of these issuances, smaller issuances, you can make real money uncovering some of these opportunities. Okay, just like I mentioned at the top of the class, that it was your job as a financial analyst to understand how Verizon was gonna pay back that 9.8 billion next year, because it was within the 12 months that we require for short-term classification on the balance sheet. If you look down into the 10K filing, you're gonna see the amount that comes due between 2023 and 2025. So your next job is to understand not only how Verizon's gonna come up with 9.2 billion next year, but 16.2 the following, and so on and so forth. What's their plan? Is this evergreen debt and the cash flow? They're gonna be selling a piece of business. How are we gonna come up with that cash flow? Okay. That's it. There's a couple more slides here before we get to learning objective 7.5, but I already talked about those. And then we move on to time value of money concepts, which I'm not going to take time up in this class to cover time value of money. So the slides, videos associated with the text, if you need a little refresher. I don't expect that anybody will have a problem. Time value of concepts. We got a little bit of time left tonight. If there's any questions, otherwise I'm gonna put some time back in the day and we'll adjourn early. Okay, let's get out of here. Thanks all. Thanks, Zoom crew. I'll see you next week. Thank you.